If you've been following property investing circles over the past week, you've seen the news. Macquarie Bank has completely paused new lending to family trusts and company structures, and this is significant. I'm Naveen Merani. I've spent years in private banking, commercial lending, and right now I work as a mortgage broker helping investors structure their property portfolio. And I wanted to share some perspective on what's actually happening here and what it means for anyone using or considering trust structures. Let me walk you through the full picture. So here's what's going on. Macquarie Bank, effective from late October, has paused all new lending to family trusts and company structures. They've cited a few reasons: increased volume applications, strategies being shared on social media about trust lending, and upcoming anti-money laundering regulations that will make those applications more complex to process. And I want to be clear about something. This is not a small player making a small policy tweak. Macquarie is Australia's 5th largest mortgage lender. For years, they've been one of the go-to lenders for trust and company structures. They made the process smooth, they understood the strategy, and they've had competitive terms. So when they take a step back, it matters. And it's created a lot of uncertainty in the market. Now, here's what I think is important to understand. Could other major lenders follow suit? Honestly, yes, they could. When you see one of the big fives make a move like this, it often signals to the broader market of regulatory pressures. The other major banks are likely watching this closely and assessing their own exposure and possibly having similar conversations internally. So if your entire lending strategy relies on major bank trust lending continuing exactly as it has been, that's something to be aware of. That said, there's another part of the story that I think is getting overlooked. The Australian lending market isn't just 5 banks. There are dozens of lenders out there, mid-tier lenders, non-bank lenders, specialist lenders, and many of them are still actively supporting trust and company structures. And in some cases, they're offering features that are actually better than what the major banks were providing. I've been seeing communications this week from several lenders essentially saying they're still here, they'll still support these structures, and they're ready to help. These aren't fringe players either. We're talking about legitimate, established lenders with solid products. What makes some of these options interesting is how they assess your loan. Some of these lenders use lower assessment buffers, 1 to 2% instead of the typical 3% that major banks use. Now, these lenders typically have slightly higher interest rates than the major banks. That's a trade-off. But if you're trying to continue building a property portfolio and you need additional borrowing capacity, they can serve as a bridging strategy. You use them to get into the property, build some equity, establish a repayment history, and then potentially refinance back to a major bank down the track if that makes sense. So while yes, one door has closed, others might close too. There are still pathways available, they just look a little bit different. I think it's worth stepping back, looking at why this is happening in the first place. Investor lending in Australia has been surging. We're at levels we haven't seen since 2017, around 40% of total home loans. Property markets in Queensland, Western Australia, Victoria, and Darwin, they've been hot. And part of that growth has been driven by investors using trust structures to scale their portfolios faster. From a lender's perspective, especially a major bank that's heavily regulated, this starts to look like concentrated risk. From a regulatory perspective, APRA and ASIC are watching closely to make sure lending standards stay tight and borrowers aren't overextending. So Macquarie's decision isn't happening in a vacuum. It's a response to broader market conditions, and likely some regulatory conversations are happening behind the scenes. And here's what that means for you. If you've been planning to scale using trust structures with major banks, you need to be realistic. That might not be the path forward that it was 12 months ago. Other major banks could absolutely follow Macquarie's lead. But that doesn't mean that trust structures are dead. It means that the landscape is evolving and you need to adapt accordingly. So let's talk practically. What does this mean if you're planning to invest through a trust? First, it means that you need to be prepared for change. Lending policies aren't static. What's available today might not be available in 6 months' time. Second, it reinforces that trust needs to be the right structure for your specific situation, not just something you're doing because you can. If you're a high-income earner planning to scale to 8 to 10 properties over the next decade, and each property is going to be cash flow neutral or positive, trust can be incredibly valuable. Each property sits in its own structure, and if it's self-sufficient, the next lender might not count that debt against you. But if you're buying your first investment property, earning $100,000 a year, and the property is going to be negatively geared by about $5,000 a year, setting up a trust might cost you more in accounting fees than it'll benefit you. In that case, buying in your personal name and using negative gearing benefits might be smarter. The point is, your specific situation matters. Your income, your goals, your timeline, the types of properties you're buying, all of these factors need to be part of the decision. So here's what I'd suggest. 1. Acknowledge the reality. Macquarie has stepped back from trust lending and other major banks might follow. 2. Understand that alternatives exist. There are still lenders supporting trust structures, often with better assessment terms than major banks. They might have slightly higher rates, but they can serve as an effective bridging solution. 3. If you're currently planning to purchase through a trust, have a conversation about what lender options are available right now. Don't assume the landscape is the same as it was 6 months ago. And 4, make sure you're using a trust for the right reasons. Talk to your accountant. Really understand the costs and benefits and the long-term implications. Make sure the structure serves your goal, not just because someone on social media said it's the way to go. Look, this is a significant shift in the lending market. I'm not going to downplay that. Macquarie's decision matters, and there could be more changes coming, but it's not the end of trust lending, and it's not the end of scaling property portfolio. It just means the strategy needs to evolve. The investors who adapt, who work with knowledgeable professionals, who make decisions based on the specific circumstances rather than general hype, those are the ones who continue to build wealth regardless of policy changes. If you want to explore what lending options are available for your situation right now, whether it's through a trust or in your personal name, I've left a link below to book a strategy call. We can look at your numbers, your goals, and map out the clearest pathway forward given where the market is today. Otherwise, I'll see you in the next video.